And this is Quinn Arnold, one of the partners at Arnold and Moat Wealth Management. Our session today is developing a charitable giving strategy to maximize effectiveness and tax efficiency. The reason we landed on this session is simple. Our clients told us that they are interested in it. So again, if you are watching this and you have questions about a particular financial planning topic, please feel free to email us or give us a call and suggest a future topic. We will be doing these webinars every 2 weeks now, or at least that's the plan for the foreseeable future, down from every week that we were trying to do them before. Just one other kind of important aspect here is that if you have any questions, please hold them until the end. We'll have some time to go over those, and then if it's a more private question to your situation, we're happy to set up a time to talk or just call you after the webinar today. So with that, I will turn this over to Matt Hillen, another one of our partners at the firm and a financial planner, and take it away, Matt.
All right, thank you, and thanks everyone for joining us again on your Friday afternoon. As Quinn mentioned, today we're talking about charitable giving, something that's always been important but is seeing much more need right now as we deal with the coronavirus especially and its aftermath. And with recent law changes, the best ways to give, both for the benefit of the charities and for your benefit, have changed. And so we thought that this is a timely topic to go through. There'll be a couple of disclaimers in the webinar today. The first one is to tell you that this is meant to be an overview of some charitable giving strategies and the tax benefits that are available with them, but will probably not be the most thorough resource for each of these strategies. We try to keep these webinars to 20 minutes or so, but just to give you an idea on how complex this, maybe should be simple topic can get, the IRS publication just on calculating the deduction of charitable contributions is about 30 pages long. And then there's hundreds more pages of laws like the Secure Act and the CARES Act and IRA laws that all kind of add on to this. So just keep that in mind that, this is our way to introduce some ideas to you, and but we can't lay out every single possible detail for your situation. But okay, let's get into it. There's always been benefits for charitable contributions, but it was a couple of years ago with the new tax law change when a little more planning became required for small or medium-sized donors to receive a tax deduction for their donations. And that was because of the change in the standard deduction. The standard deduction is the deduction that you can claim on your taxes with no questions asked from the IRS. No matter what you did during the year, in 2017, if you were married, you could get a $12,700 deduction. If you had more deductions, say from mortgage interest or property taxes or charitable contributions, you could itemize your taxes and claim a higher deduction. Then in 2018, that standard deduction almost doubled overnight from about $12,000 to $24,000. And in 2017, before the tax law change, for a lot of Americans, it was pretty easy to get above that standard deduction amount. If you had a mortgage and paid property taxes, that alone probably got you there. These numbers here are representative of the mortgage interest and taxes for about a $250,000 home in Johnson County, just for example. And what you can see is that, if this person or this couple in 2017 wanted to make a charitable donation, even a small donation, that entire donation would have been tax deductible because their other donations like mortgage interest and real estate taxes had already gotten them up and over that standard deduction of $12,700. They could have donated, a very small amount, even $100, and received a full $100 deduction on their taxes. But that changed in 2018. Now the standard deduction is much higher. This makes filing your taxes easier because now about 90% of Americans can simply claim the standard deduction and go on their way. But it had a very bad impact for those who were donating for a tax deduction. And as we see here, now this exact same household will receive no added tax deductions for their $2,000 donation because they fall under the standard deduction. So this change in 2018 added another wrinkle to a charitable giving strategy, especially for those who want to contribute smaller amounts during the year and receive a tax deduction. But there are still ways to donate and receive a benefit even if you fall under the standard deduction today. The first and easiest change was simply to group or bunch your donations to get you up above that standard deduction. So instead of giving $2,000 per year, maybe you give $10,000 every 5 years. This would give this example couple over $24,000 in deductions for the year. So now they can itemize and receive extra deductions for their increased charitable giving. However, it's still not a perfect solution. Notice even with $10,000 in donations here, this couple is only getting a $2,000 added deduction over the standard deduction, even with their $10,000 donation. So it's an added benefit, but unless you're donating large amounts, multiples of the standard deduction, it is hard to realize the same benefit as before the tax law change. A recent law has made one improvement to the situation. The CARES Act, which was recently passed in response to the coronavirus epidemic, added one small benefit for those who want to donate to charity. And that's an added $300 above the line deduction for charitable contributions. Even if you claim the standard deduction this year, if you give $300 to a qualified charity, you can get a $300 deduction. A couple of interesting notes about this. In the draft of the CARES Act legislation, this was written only for 2020 and it would go away next year in 2021. But the copy of the bill that was voted on and actually signed into law has this worded with a little bit more ambiguity to where people read it as a permanent change. And so I hope it is, but we probably just have to wait and see if this change sticks. And second, the law is written saying that a $300 deduction is available for an individual who has a qualifying donation. Most items in the tax code have double benefits for those who are married and filing jointly. So it would seem like this should be a $600 deduction for married couples. But that isn't exactly spelled out in the law. And I think we'll get some clarification from the IRS before the end of the year on this. Hopefully it's a $600 deduction for married couples, but we don't know for sure yet. So you should feel confident making a $300 donation to get that $300 deduction, but maybe save that extra $300 for the end of the year if it's a big concern for you. And last note, this deduction is for cash donations only. So contributions of stock or clothes or vehicles do not count towards this benefit. Make a cash donation and keep a receipt from the charity that you made the donation to. And also contributions to donor-advised funds, which we'll talk about later, do not count towards this $300 deduction. It must be cash or a check given directly to the charity. But bottom line, for 2020, this $300 cash donation should be one of your highest priorities for giving because everybody can take the deduction for it. And it's cash that goes directly to charities, which is important today as well. Once you get above that $300 donation, there are other strategies to help you save on taxes and provide the most bang for your buck for charities, even if you're not donating really large amounts of money. One simple way is to donate investments to a charity rather than selling the investment and giving the charity the proceeds. Just as an example, one of the benefits of this strategy, consider 10 years ago you purchased an S&P 500 index fund. And just for example here, I used 20 shares of the most popular ETF today, SPY, which 10 years ago was about $115 a share. Today, that investment that was worth $2,300 10 years ago has almost tripled and is worth about $6,000 now. So let's say you want to donate this to a charity. Your first inclination may be just to sell the security and give the charity cash. But look what happens when you need to pay capital gains taxes on the difference from the $2,300 original investment and then the $6,000 it's worth today. For most, that gain is going to be taxed at a 15% long-term capital gains tax rate. So you end up with about a $555 tax bill, which leaves $5,445 left to the charity. The charity will obviously be very grateful for this donation, and you will be able to take a deduction for $5,445 if you itemize your taxes, but there's still a better way. Instead of cashing out, let me go back here, sorry. Instead of cashing out the security, you could donate the 20 shares directly to the charity. This can be done a few different ways, one of which is a donor-advised fund, which we'll talk about in just a few slides. But you can transfer those 20 shares worth $6,000 directly to a charitable account. You receive a $6,000 deduction if you itemize, and now the charity gets $6,000 instead of $5,455. Because remember, the charity will not pay the taxes on the gains like you would. So you get a $555 larger deduction, and the charity gets $555 more dollars. It's a win-win scenario. Another very popular way to make donations, and even small donations, and receive a tax benefit is available for those age 70 and a half or older. This is a special distribution from your IRA called a Qualified Charitable Distribution, or a QCD. A QCD allows you to give money directly from your IRA to a charity. For our clients that have this set up, we can get a special checkbook that's used for QCDs, or it's as simple as just signing a form through Schwab. But either way, it's very easy to do. If a client wants to make, even just a $100 donation from their IRA, they can let us know. We'll make sure cash is available. And then they can simply give the charity a check or send the charity money through the paperwork with Schwab. And it's very simple. There's a few primary benefits to this. First, it avoids you making the withdrawal and facing income taxes on the withdrawal from your IRA. And second, any QCD counts against your RMD, or required minimum distribution for the year. So if your RMD is $10,000, you can, just for example, write a $1,000 QCD check to a charity, and then you will only have to withdraw $9,000 to satisfy your RMD. This saves you income taxes on the $1,000, which for most can be a couple $100s. Let's look at the benefit of the tax savings and increased charitable donations that a QCD can provide. Let's say you have $10,000 you want to donate from your IRA, and like in the previous example, your first inclination might be just to withdraw the money from your IRA, put it in your checking account, and then give the charity cash. With this scenario, you'll pay taxes on the IRA withdrawal. If you're in the 22% tax bracket, that amounts to $2,200 in taxes. Then you give the charity the remainder, or $7,800. Again, the charity will be very grateful for this donation, but you can do better. By doing a QCD, you simply give the charity a check from your IRA for $10,000. The charity gets the entire $10,000. You avoid the $2,200 in taxes that you would have paid for the $10,000 withdrawal. And that's a huge difference for both you and the charity. It's hard to talk in absolutes, but if you are over age, if you're over age 70 and a half, or especially age 72, and taking RMDs and are charitably inclined, QCDs should very likely be your first priority for charitable contributions. It's the best way to give you a direct deduction in taxes, regardless of whether or not you take the standard deduction, and the charity receives the largest amount possible. And I should say there are some limits, such as the $100,000 per year to QCDs. So if you want to make really large donations, there may be better or other options you also need to consider. But for the vast majority of our clients, QCDs are the best and simplest way to give to charity. And so those strategies we talked about before cover the needs of a lot of people for normal or maybe regular annual charitable contribution amounts. Now we want to move to some options that exist for larger donations, maybe one-time donations or end-of-plan donations, and how to maximize the tax benefit for you and the charity. The first example is one to show you how a charitable giving plan is connected with the rest of your comprehensive financial plan. For those of you who are charitably inclined and want to leave assets to one or more charities at the end of your plan, your estate plan is very important. I thought it was best just to show a simple example of why this can be the case. Let's say you want to leave half of your assets to charity at the end of your plan and half to children or family. For simplicity, let's just say you have $250,000 in an IRA and $250,000 in a Roth IRA. If those assets get split evenly, the charity will be given $125,000 in IRA and Roth IRA money, while your family will get the same. The problem is that your family will now be stuck paying income taxes on the IRA money. If they're in the 22% bracket, this represents about $27,500 in taxes. And so adjusted for taxes, your family now receives about $222,500. And like the other examples, there is a better way to do this. If instead your estate plan calls for the accounts to be split up by account type, you could direct the charity to receive $250,000 in IRA assets and your family to receive the Roth IRA assets. With this scenario, the charity still gets $250,000 and your heirs get $250,000 in tax-free assets, since inherited Roth IRAs are not taxable like an inherited traditional IRA. So this is just one example of how a little extra detail in your estate plan can really help out both the charity and your family. One quick note as we get into topics for larger donations. In the past, deductions for charitable contributions were limited to 60% of your AGI, or your adjusted gross income. This is calculated on line 8B of your tax return, as we tried to show here. So if you had an AGI of $100,000, you could only get a tax deduction this year for the first $60,000 in donations. You can still carry over any excess donation deduction, but it might not have the same impact. For 2020, there's a special exemption for that 60% limit. It is now 100% for cash donations. It's important to note this 100% limit only applies to cash, so the donor advised limit, which we'll talk about in more detail later, remains at 60% of your AGI. Now, this can obviously be very good for someone with very large income who wants to make a large donation. If you sold a business or held stock in a company that was sold or had some other large taxable windfall and wanted to make a large charitable contribution to help offset those taxes, there are big benefits for doing that this year. But this also applies to many others in more typical situations as well. Many retired couples who live off Social Security and small IRA withdrawals have very low AGIs, and in prior years may have hit that 60% deduction limit fairly easily. 2020 gives them and everyone really the opportunity to make a donation and effectively pay no income taxes this year. Another very popular way to make donations is through a donor advised fund. A donor advised fund lets you make contributions today, realize a tax deduction for the full amount this year, but distribute that money over time. The money is irrevocable, meaning once you donate the money into the donor advised fund, it cannot be undone. So if you donate your life savings to a donor advised fund and then need money later in life, you can't pull it out to use for yourself. Once the money's in there, it's in there for good. It is a way to perform the bunching of donations that we talked about early on. So if you want to donate $2,000 every year to charity, you could donate $20,000 into a donor advised fund today, realize a full $20,000 deduction for this year and still just distribute $2,000 a year for the next 10 years. There's also an added benefit that the assets in a donor advised fund can be invested so they can grow over time. So if you put that $20,000 in today, and hopefully over the next 10 years, that money can grow with the stock market and result in you donating much more than $20,000 in the end. And one quick note, we talked about the complexity of some of this. Donor advised funds are one of the simpler ways for most to realize a large tax deduction for charitable giving, but there is still some fine print, or actually there's a lot of fine print. The IRS has a publication 526, I think, that just talks about how to calculate charitable tax deductions. It's about 30 pages long, and it has a 2-page worksheet, 1 page of which I'm showing here, to help you calculate how much of your donation is tax deductible if you use donor advised funds. So as we said earlier, we want to give you an introduction to things like donor advised funds and their benefits, but we also want you to know that it can be a little bit more complex than just simply getting a deduction for every dollar that you put into a donor advised fund. Where you run into limits and some of this complexity is in very large donations that amount to 60% of your AGI or 30% of your AGI if you're only using appreciated securities to fund the donor advised fund. Again, if you do contribute more than you can use this year for deductions, you can carry over any excess deductions for future years. It just might not have the benefit and the tax savings you were hoping for. We say this all here in hopes that you'll include us if this is something you are considering, because there's a lot we can do to make all these details work in your favor. The last strategy we're going to introduce to you is called a charitable remainder trust, or sometimes just called a CRAT for short. There are several variations of these, but in general, they are trusts that accept your donations but pay you a certain amount of money per year until you pass. Once you pass, the remaining money in the trust goes directly to the charity outlined in the trust document. This has some advantages over a donor advised fund, for example, because it can allow you to earn some income from your investments, which gives a lot of people a sense of security in retirement. A lot of people find it hard to part with a large portion of their net worth in retirement because of the uncertainty we all have. You might live to be 110 years old, you might need extra money for health reasons, etc. Remember, if you make a very large donation to a donor advised fund, you are never able to get that money back. And if that makes you concerned, you could instead donate to a charitable remainder trust and agree to receive a certain amount of money per year for as long as you live. That gives you some amount of income and maybe some amount of safety, but still accomplishes a goal of setting aside a large amount of money to a charity while you're still alive. A charitable remainder trust can be a simpler way to make sure that money gets where you want it to go if you don't have other reasons to have a more complex trust. If you don't have a complicated situation like property in multiple states or farmland here, you may not have a reason to get a full trust made up, and a will may work just fine for the rest of your assets. For those in that situation, a charitable remainder trust is easier and cheaper than having a general trust made up. And the assets in a charitable remainder trust are not contestable in the will. The money is out of your estate, it's in a real trust, and the money is certain to go where you intended it to go. You do receive a tax deduction at the time you fund a charitable remainder trust, but it will probably be lower than if you used a donor advised fund. The formula for the deduction is complex and has a lot of variables. It depends on your age, how much money you contribute, general interest rates, all of which is defined by the IRS. So they certainly can provide tax savings, but you need to run the numbers with us and a tax professional to determine if it's the right course of action for you. And the last slide here, but we wanted to bring everything full circle and back to your financial plan, because there are ways that donations you make can benefit both you and the charity. So it's wise to think about how to best pair the deductions you can get from making donations with other items in your financial plan. Just as a final example, we use some numbers, maybe representative of a retired couple just living off Social Security and small distributions from an IRA. Because only some of Social Security is taxable, their AGI is very low. Now, if this couple wants to make a large donation this year in excess of their AGI, this opens up a lot of planning opportunities. They could do a Roth conversion, for example, for effectively no tax. They could take capital gains from some investments that have appreciated in value and offset those gains with their charitable deduction. Or you could offset taxes from a larger IRA withdrawal, maybe to take out money you'll use for a family vacation in the next year or two. We just say these examples here to make sure you know that we can help you not only with your charitable giving strategy, but also see what other secondary benefits these donations can provide you. So please reach out to us if this is something we can talk to you about in more detail, or if you have a strategy in mind that you'd just like us to second check or optimize. That's all I have for today. Thanks again for joining us. Have a great rest of your week, rest of your weekend, and stay safe, and thank you.
Thank you, Matt. Okay, I have a couple questions, and then we'll also open it up generally if anybody on the webinar wants to ask questions. So just a couple of things to confirm with you for appreciated investments. So stocks and mutual funds and things like that that have gone up in value that you could donate to charity. That would need to be from what we call a taxable brokerage account, correct?
Yes. Yep. Yeah. Good.
Okay. So if somebody has mostly IRA assets, that's not really a strategy that's much in their wheelhouse.
Yes.
Okay. And then for QCDs, those qualified charitable distributions from IRAs, can you go back over again just how does somebody who's working with us take advantage of it, those two ways?
Yeah, so we have clients that both have, it's a checkbook for their IRA, and you can write a check to the charity just like a check that you're used to from your bank checking account. The money gets deducted from your IRA. It's very simple, but that check gives us a record, or gives your tax preparer a record, the IRS a record, that money went directly to a charity, and that it'll count against your RMD or offset your RMD, and not be taxable distribution for you. And then for one-time QCDs, or if it's something you are not going to be doing regularly and don't want to juggle another checkbook, we can just do a simple form with Schwab, that you'll have to sign, but that can transfer money to the charity.
Great. Good. Okay. So I think the main takeaways today, other than, we are more than happy to talk through with you your particular giving strategy, but, it's take advantage of the $300 extra donation allowed this year for people who have IRAs and are at least 70 and a half. Taking advantage of QCDs for regular giving is a great thing to do. And we're trying to talk to everybody who has those opportunities to make sure they take advantage of that. And then for others, considering things like donor advised funds, appreciated assets, charitable remainder trusts are all good ways to do small and large donations. Are there any questions out there that people feel comfortable bringing in front of the group? If you do have a question, just take yourself off mute. Okie dokie, that's all right. If you have anything that you want to follow up on over email or with an appointment, please let us know. We'd be happy to talk through that. And Matt, any other questions or comments from you?
No, I don't think so.
Okay, great. Well, thank you everybody for your time, and we will plan to see you again in 2 weeks for our next webinar. Thanks and have a good day.
Thank you.
Thank you.